Thank you so much for that, Puneet. Opportune time to bring in Sandip Agarwal, fund manager and co-founder Sowilo Investment Manager, to talk to us about IT and maybe a bit more as well. But Sandip, let me start off with that critical question with regard to IT. What is it that you're looking out for? IT's growth, both FY24, FY25, hasn't been impressive, nor has TCS's growth been too impressive. Do you believe maybe FY27 is the year when mid-teens kind of growth kicks back, and can they even do that? Is that even something which is realistic?
Hi, good afternoon, and thanks for having me on the show. So I will reiterate my view. This is a mature industry with 18-20% penetration in US in the outsourcing side. So 15% growth can only happen if 2 years there is no growth, which happened post-COVID. So that is what my view, which I hold clearly, that this is the industry where large caps will keep on growing at a CAGR of 5-6%. Some benefits of margin, some buyback benefits, and you will see 7-8% kind of earnings growth for the large names. For the mid-size and smaller size names, there will be 3-4% better growth and 3-4% better earnings growth. But this is where the sector is. But having said so, I realize of late that many funds have started looking at replacing some portion of their FMCG basket with IT basket, saying that when growth is similar, why to pay double multiple? And that is the reason the sector has hold on to its gain and it is doing well. But fundamentally, I think expecting beyond 6-7% revenue growth for large caps with slight margin improvement is very, very optimistic. I think that is where the sector will be.
Okay, and that's obviously over a slightly longer term period, Sandeep, that you're talking about. So you're saying that the average growth clip in terms of CAGR should not be over maybe 8% over a prolonged period of time, maybe over the next 10 years or so for TCS. Is that how you're looking at it? And you spoke a little bit about valuations, comparing maybe a TCS or large cap IT with FMCG. But both therefore look expensive.
Yes, definitely expensive, because we also have to remember that with agentic AI coming into picture, Gen AI coming into picture, the efforts are going down madly. We are seeing that in our business, we are able to achieve the same objectives with much less effort. So I can make out that what is happening globally. So if efforts are going to go down so much, there is only so much you can do on the realization side. So obviously, even 6-8% growth for 10 years, I am not very confident. I will rather say 5-6% growth for 10 years for the large cap is most optimistic scenario, with little bit of delta because of buyback, because buyback reduces the number of shares, so your EPS growth could be slightly higher. But I don't see anything beyond that. If 2 years there is zero growth like we saw it in COVID, then third year could be 12% growth. I don't deny that. But
valuations,
more
therefore,
than that, it is very different.
Sandeep, valuations, therefore, sorry for interjecting, but valuations, therefore, give us that perspective. Because TCS currently trades at around 25-26 times, trailing 12 months, but that's how it trades at. So how do you view valuations?
So I am very uncomfortable to give more than 3 times PEG ratio to such large companies with 6-7% growth. I think that is where they are trading. So they are in uncomfortable zone. I will not comment on any specific names, but most of the large cap in Indian tech today are at very expensive valuations, and growth will be limited. So we are very cautious of that. Rather, you should look at sectors like ER&D, where growth could be double of the IT services growth. There again, the problem is that the multiples are double the multiples of the large cap. So some time correction, some price correction has to happen. Then only, the sector will start looking attractive. Otherwise, the whole sector is quite expensive. Right now, the only investment rationale is that you switch something of 50 multiple with 25 multiple and same output. That is what, people are doing probably.
If you had those stocks in your portfolio, would you do that swap as well, Sandeep?
Yeah, if I had, but I don't buy any of the expensive stuff. We are a deep value fund. So we would rather do bottom-up analysis and buy something.
Where is deep value currently? I know it will be bottom-up. It won't be sectorally, but still, which are the themes where the deep value might be available?
So power transmission, ancillaries, power ancillaries and all, because the PEG ratios are low. They may be looking expensive, but the PEG ratios are low. Whole manufacturing belt, I'm saying, Neeraj, so much money people have made in last 3-4 years, and next 10 years, I think there's a huge amount of money in power ancillaries in the capital goods side. Because the P ratios may be looking expensive, but the PEG ratios are really cheap, much better than what we are seeing in, tech and FMCG. So we will always prefer, lower PEG ratio than higher PEG ratio. And those are the pockets, water treatment. These are the industries which are doing phenomenally well. Even banking, I think after 1 or 2 quarters, the large banks may look good. NBFC is looking decent. So these are the spaces where there is a lot of money which can be made.
So And then in power ancillaries, is it largely transmission and distribution, or are there others where the PEG ratio is really good? It could be equipment companies, whatever.
Yeah. So equipment companies are there, small cable companies. We are very bullish on the small cable companies. We are not very bullish on the large cable names because they are quite expensive. But the smaller cable names, you run a screener, you will find their stocks with 12, 13, 14 multiple also. And they are going to give phenomenal returns. And there are some wire companies which are also going to do phenomenal because this is a structural story. We like those names. We like some transformer names, but transformers is a very, very well discovered story and very expensive now. So we are not so keen on that. But wires and cables is very, very good space. And then distribution, transmission, some spots are there where the valuations are very reasonable. So we love them. We love the private banks. We love the NBFCs. These are the spaces where I think a huge amount of money will be made.
Okay, thank you so much, Sandip, for coming and speaking with us on the eve of the TCS earnings as well as Q1 FY26 earnings. So both of those to look forward to. But it's time for another exclusive with the 9th